Hooty hoo, all my stock market gamblers. Welcome today. We made it to September 1st. I'm Tall Mike. I'm so glad you're here. What do we got going on? Well, we're starting the month off with new record highs. NASDAQ at a new record high, S&P right behind it. Can we get a new record high every day in the month of September? Wouldn't that be incredible? I suppose it's possible. Do I believe that's going to happen? Absolutely not. Now, a lot of people are calling for a correction in the month of September. Some are even calling for a crash in the month of September. Now, what do I think's going to bring the correction? What do I think's going to bring the big crash? Now, when the big crash happens, it's going to be big. Now, what I think will bring the big crash is the debt. The debt. I mean, we got $28 trillion in government debt, right? That's just federal. We got the states are all in debt. We have the cities are all in debt. We have personal debt. Personal debt is really skyrocketing right now. I mean, we got the student loans out there. That's still a huge problem, 1.7 trillion. Credit card debt about 1.6 trillion, and auto debt is well over $1 trillion. Everybody's in debt, but what's going to bring the market down? Well, let's talk about this. What about corporate debt? Corporations have never been in more debt than they are right now. Now, looking back to the great financial crisis, okay, this is easier for me to understand because I'm a real estate guy. During the great financial crisis, what brought the markets down? What made the crash happen? Well, it was the subprime loans, right? Okay, that was debt. So they would bundle up these loans and they would sell them into the marketplace. Now, basically, Wall Street wanted to get into the real estate business, and they wanted to do it with the purchasing of mortgage-backed securities, this instrument. So they would lend money to basically anybody back then. Man, if you were breathing, you could get a loan. It was funny. I mean, strippers were going in and getting loans for over $1 million in the area I live in. It was just wild. It was wild times. I mean, you didn't even need a job. If you were breathing, they gave you a loan. What'd they do with these loans? Well, Wall Street couldn't get enough of them, so they bundled them up. They packaged them together. Now, you got to have a rating on the loan. Now, this is where it got a little funny. Okay, so you needed to rate the loans after you bundled them. Well, you had to bring them to a rating agency. Now, what did the rating agencies do? Well, rating agencies get paid to rate your loans. Now, this is very conflict of interest. The people that were having their loans rated would pay the rating agencies. Now, I don't know if they paid them a little extra to get them rated AAA, but it was magical. All the mortgages were rated AAA quality. Really interesting, right? So then they sold them to Wall Street as AAA. Wall Street thought it was kind of funny when no one was making their mortgage payments on these AAA loans. So these rating agencies, they kind of got a little slap on the wrist going, well, you were taking money to make it AAA. Well, what's going on in the corporate world right now? Well, the corporate debt is also being rated by rating agencies. Now, when companies get their debt rated, okay, they pay the rating agencies. The company that is being rated is the one that pays the rating agencies. So look, if I'm paying a rating agency, I'm going to say, hey, you're going to give me AAA? No, you're not. Really? You're only going to give me triple B? Let me check down the road and see if I can get AAA from them. Well, maybe I'd give you a little extra money with that. Get me AAA. It's kind of funny what's going on with the corporate debt. Now, corporate debt's interesting because you have so many zombie companies. Look at zombie companies. We talked about this before. It's when a company cannot even bring in enough cash flow to pay the interest on their current debt. So what do they have to do? They can't pay the interest on their current debt, so they have to solve the problem by borrowing more debt. Very fascinating, right? So they borrow more debt to pay off their current debt, just the interest on it. Okay, so we got these zombie companies out there. Now, what's really fascinating, a lot of these zombie companies are triple B rated. Now, triple B rated means basically that, pension pension funds can buy it. Funds cannot buy junk debt, so you got to get your debt rating up so they can buy your debt, and then your interest rate will be a little bit lower, right? So all these corporations, zombie companies, borrowing money that's never ever going to get paid back, and they're getting rated at triple B. Triple B is pretty high. Now it's not triple A, right? But anyways, rating agencies are starting to warn right now. They're saying, hey, wait a minute. There's too much corporate debt. Now, how did we get so much corporate debt? Well, the Federal Reserve printed money and gave them to the corporations. They say, we'll buy the corporate debt here. Federal Reserve can now buy corporate debt. Do you think that's a good thing? I don't know if it's a good thing, but it's getting corporations to borrow a lot of money at 1%. That's never, ever, ever going to be paid back. So the Federal Reserve's in the game now. Now, what are they doing? They're loaning the money to companies at 1%. What's the company doing with the money? Well, they're not investing it. No, what they're doing is they're buying their stock back. They're buying back stock. Now, where's the stock market right now? Stock market's at a record high. Do you want to be buying back all your stock when your stock is at a record high? And you know you're a zombie company because you have to keep borrowing the money to pay your debt. But they give you extra money so that you can go buy your stock back. The stock buybacks are back in vogue again. It's starting to happen. Corporate debt has never been at this record high. They keep blowing air into this bubble. This bubble's going to pop, I'm telling you. But now here's the black swan. Here's the black swan. Okay. Now let's talk a little bit about the stock market first. Okay, we're in a 13-year bull run. 13-year bull run. Never's happened before in the history of our stock market. Never's happened before. 13 years straight up. If you're a millennial, you've never seen a bear market. You had 13 years of straight up. Incredible. And now August was the seventh month. Okay, seventh month of straight up new record high. Now, we have not had a correction until last September. So it's been a year since we've had a correction. We haven't had a correction all year in 2021, but it goes back even farther. Goes back till last September. Okay, we have not had a correction. Now, is this normal? It's not normal. Look, do you think our economy's driving the stock market up higher and higher? I'm telling you, no, it's not. It's the Federal Reserve pumping the money, keep pumping the money, and money's got nowhere to go, so it goes into the stock market. This is incredible, just incredible what's going on. Look, we haven't retested the 200-day moving average in the stock market since March of 2020. We're going to retest that moving average at some point, and I think we're getting really close. Now, why? Why do I think we're getting really close? Well, here's the black swan event. Okay, we just got this trigger, right? We just got this trigger. Here it is. Margin debt. Once again, it's debt that's going to break the market. Margin debt hit a record high. $828 billion in June, right? But in July, the margin debt came down. Why? The stock market's still going straight up. Why did the margin debt come down? I'll tell you why. Margin debt has peaked out. It peaked out in June. It is now coming in. Margin debt has peaked. It's peaked. Hit the peak at $828 trillion. It's coming in. Why is this important? What's the last two times when margin debt peaked out? What is the last two times this happened? Well, the last time was right before the great financial crisis. In 2007, margin debt peaked out. What happened? Boom! Great financial crisis happened. What about the time before that? When was the last time before that margin debt peaked out? Well, guess what? It was in 2000, right before the NASDAQ bubble popped. Boom! So it peaked out in 2000. Boom! Peaked out in 2007. Boom! It just peaked out again. Guess what's going to happen? Yeah, you got it. Boom! It's going to go down. Okay. Now I'm getting ready to short this market. Not yet, though. Not yet. Another day or two. I'm looking at, though. I might put a small position on in the short. maybe short the QQQs, maybe short the technology, maybe short the SPY, but it's getting close. I don't think it's quite there yet. It's still going up. I mean, people tell me, Mike, just look at the charts. The charts are telling you to buy. It's going higher. Well, the charts aren't the only thing I look at. Look at. I look at the margin debt, right? And the margin debt, well, it's just peaked out. Okay, what else do I look at? I look at the VIX. The VIX is screaming that the market's going to come in. Look at there, the put to call ratio, 10-1. Okay, and pricing on that. Okay, to buy a call on the VIX is 10 times more expensive than it is to buy a put on the VIX, because nobody believes the VIX is coming in any farther. They think it's going to explode higher, which is going to send the market down. The VIX is a fear index. When that goes up, it's because the market's crashing. Look at, we're getting really close. Now, is it going to happen in September, the pullback? I think we're going to pull back and test the 200-day moving average, and that'll be over a 10% drop, 10% correction. I think we're getting here. I think we're really close. Will it happen in September? I think it might. Nobody knows for sure. Nobody knows for sure when this bubble is going to pop. Now, I don't think the big crash is here yet. I think they're still printing too much money. But I do think we're going to get that correction, that 10% correction. We may come back and test this 200-day moving average. I think that's going to happen this year. Probably September, probably this month. But hey, we just started, right? And we're already at a new record high. Maybe we just hit record high after record high all through this month. But I don't think so. I think we're getting closer to the end. Anyways, if you like this stuff, give me that thumbs up. You really like it? Hit that subscribe button, I'm Tall Mike. Get out there. Have a great Wednesday. We'll talk again really soon. Bye-bye now.